the possibility of loss, the possibility of things not working out, the downside of taking some sort of opportunity. And in the markets, it's the risk of losing money. It's the opportunity that you may lose whatever you invested in your account. So if you put $1,000 in, you could lose $1,000, or maybe if your risk is crazy, you could be losing 10,000 for putting $1,000 in. That's when you get into like different numbers of like leverage, borrowing money, stuff like that. But risk, all it is what will happen potentially if things go wrong. So we need to look at that. And when you're investing in the market, you need to figure out what is your risk, what can go wrong. So if you put $1,000 in, we're going to keep it simple. We're buying a basic stock. Your most risk you can take on is the $1,000 that you put in. You put $1,000 in, the company goes to trash. If it fails, you can lose your whole $1,000. But what we want to do as investors is learn to manage our risk. So how do you do that? So the best thing to do is set a game plan in place. And to do this, you want to look at the stock you're investing in. You want to say, okay, I'm willing to risk $50 of this $1,000, or I'm willing to risk $100 of this $1,000. And you realize, okay, if it drops below this said level, I'm going to get out. I'm only going to lose $100, and I will reinvest this $900 somewhere else. So it's all about creating a game plan and a strategy for, if this happens, what am I going to do? If this goes good, yay, I'm going to celebrate, but I'm going to have some type of level that I'm getting out to avoid the risk. If it goes bad, I'm going to have some type of level, okay, I'm getting out because I don't want to lose any more money. And that's all it's about, basically, just managing your risk. Understanding that is going to get you way ahead of a lot of investors, just understanding the concept. You want to understand what you're doing if it goes good, what you're doing if it goes bad, okay? So what in this game is, you're going to have a win rate and you're going to have a losing rate. So your win rate is going to be how many times you win a said trade. So let's say you buy $1,000, same example. We buy $1,000 worth of stock and it goes up to, I don't know, now your portfolio is now $1,100 because you made $100 on said investment. The next investment you take, let's say you take another $1,000 and you lose it. And then it goes back down to $1,000. Let's say you do this 100 times and you realize you can win with whatever system you're using, however you're investing your money. You realize you can win 50% of the time and you're losing 50% of the time. That would be your win-loss rate. And you need to figure out your win-loss rate because that's going to be very important in predicting how much money you can make over a long period of time, how much money you're expected to make. And it also keeps your psychology at a good place where you're thinking, okay, I can relax because I know these next 10 trades that I do, these next 10 investments that I make, I know there's a 70% chance that I'm going to win, or there's a 80% chance I'm going to win, or maybe even a 90% chance I'm going to win. So understanding your win rate, your loss rate is going to be very important. On top of that, you need to figure out your win-loss ratio. So there's two things you need to focus on in this game. You need to focus on your win rate. So let's say the hypothetical that your win rate is 60%. So you're winning 60% of your trades. But your win ratio is, in this $1,000 example, let's say every win you're winning $50 and every loss you're losing $25. That means you have a good win to loss ratio because you can take two losses for every win. That would be a 2-to-1 ratio. So every time you win, it's equivalent to 2 losses. So it's good if you were having, in a perfect world, you have a 60% win rate and you're winning 50, you're winning at a 2-to-1 ratio where you're making 2 times more money than you are losing every time you lose. And seeing that would show you that you have an equity curve, a stock portfolio that is going to consistently go up because you can continue to play the odds. 60% of the time you're winning $50 and 40% of the time you're only losing $25. So it's going to consistently trend in the upward direction. So those are the two things we need to focus on. our win rate and our ratio, our win to loss ratio. You can play with these things. You don't need a win rate that is 60%. You can play with a win rate that's 30%. You can play with a win rate that's 20%. If you're winning 20% of your trades that you take, as long as you change the formula for your strategy, where if your win rate is 20%, your ratio may be 10 to 1. So every time you take a win, you win, let's say you win $1,000 every win, but every loss you only lose $50 or $100. So you can afford to lose a lot because the losses are so small in comparison to the wins. So that's going to be very important, understanding that ratio and finding out that mathematical equation that works for you in determining, okay, my win rate and my win ratio. So how do you figure out all these formulas and what goes on with that? That's very important. What you have to do, you have to back test your strategy. And what is back testing? Back testing is taking a strategy that you have designed and putting it to the test. You're putting it against history, you're putting it against current market conditions, and you're also testing it into the future, how it would perform. So let's say you take a simple system. One of the most popular systems people use today is the breakout strategy. And a breakout strategy simply means you are buying a stock as it breaks over a key level. Maybe it's all-time highs, or it's a key level that is having trouble getting over. And I'll show y'all an example of that right now. What that looks like, it's simply a stock has a resistance level that is struggling to get over, and then the price of the stock breaks above that said resistance level or that all-time high level, and then it continues to trend upward. So that is a very popular strategy that people use. So let's say we take that strategy there and we test it. We test it on 100 different stocks, and we see, what is the win rate of the strategy? How many times can I win if I play this strategy every single time with those parameters? So we put a breakout strategy. Let's say we put our risk, like we said, we put our risk. So we're going to put a stop loss where we are not taking any more risk on our portfolio. We're going to immediately get out if the play doesn't work. That would be our stop loss. We're going to put a stop loss, and we're going to set a target. And we would probably set maybe like a 2 to 1, a 3 to 1. That tends to be the most common setup we would use. But we would set that up, and then we would test how many times does it win and how many times does it lose, because we're keeping it very simple. We want to keep it simple where if you put a monkey or a computer in front of it, they could copy the system and they will come out with the same exact results. We want to keep the human error out of it as much as possible. We just want to test and see how that goes. And then we're going to get a win rate, and then we're going to get a win ratio. And that's how we're going to figure out, okay, how is this system working? And once you figure that out, then you can take the system, put actual money into it, and see your account begin to grow and build. And that's how we determine our risk, how we're comfortable with the risk. Is it going to work out long term? And is it a good strategy for us to work with? Maybe it's not. Maybe it doesn't work. But if it does, we can put actual money to it and just be good. Last but not least, you want to learn how to position size. And I'm going to put a position size calculator up right here. Basically, I'm probably going to do a whole separate video to this one because this is a very important topic. But position sizing is when you try to manage your risk. And what you want to do is, let's say you have that $1,000 account. Maybe the way you're placing your stop loss on a particular stock is very far away. Let's say the resistance level where you need to get in versus where you need to put your stop loss at, where you need to get out, it has a big gap on it. It's a very big distance on it. And if you put $1,000, your whole account in, you may be risking too much money. So let's say if this distance is 20%, you may be risking $200. We don't want to do that. We want to divide our account up so we will only risk a small percentage of it, which is usually going to be about 2% of our account. So we want to put enough money in there where we're only risking about 2% of our account, but we're not putting so much where if we lose, we're blowing up our account and we're really hurt. So I am going to break down position sizing a little bit more, but that's basically how it works. It just tells you how much of your account you can purchase with this particular stock here, because sometimes it gets too expensive where if you were to get into the stock, it's just too risky because the way it moves would greatly hurt your account. So be wary of that. I'm going to make a separate video to that, but that is how you determine your risk, how you set up your risk, and how you create a ultimate risk-based strategy where you can consistently win in this market. If you have any questions, let me know in the comment section down below. If you stayed all the way through this, make sure you leave a like on this video, and we out. Stay blessed.